Happy Monday, everyone. I hope you enjoyed the last video where we covered the high-level changes to the tax code under the One Big Beautiful Bill Act, now law. We talked about the small changes to the tax brackets, the new deductions available to seniors to replace the no tax on Social Security pledge, and now we'll go a little bit into more detail. Under the One Big Beautiful Bill, there were many changes to itemized deductions. The table to the right summarizes the changes to the main categories, but I want to dive into a couple of the specific ones that have been hotly debated over the last couple of years. Let's start with the deduction for state and local taxes, otherwise known as SALT. Under Trump's first tax bill, deductions on these taxes were capped at $10,000, which made it so that most taxpayers took the standard deduction and didn't have to track their health expenses, medical expenses, how much they paid in state and local taxes, etc. And this made filing your taxes simpler. With the majority in the House very thin, Republicans in high tax states such as California, New York, New Jersey used this leverage they had to increase this state and local tax deduction under the new bill. This benefits higher income taxpayers in states with the highest tax rates. However, like many of the other deductions in this bill, the benefits are capped based on income. So what did it do? It increased the state and local tax deduction from $10,000 to $40,000 through 2029. The income limitations start whether you're single or married at $500,000 and fully phase out at $600,000 of adjusted gross income. The deduction never falls below $10,000. And a new feature is that now this deduction is going to be adjusted for inflation from 2026 to 2029. Another big area is the mortgage interest deduction. This was also capped under the last tax bill, and home equity interest was also limited. So the big change this time is that the deduction of mortgage interest on debt up to $750,000 is still there, but now it's made permanent. You're still not allowed to deduct interest on your home equity loans or lines of credit unless the funds are used to acquire, construct, or substantially improve your residence. In past years, families in particular borrowed money from their home equity line of credit for maybe a wedding or to pay for college, and then they would deduct that interest. That has not been allowed for several years now, and it's still not. However, what this does do is it restores the deductibility of mortgage insurance premiums. This is known as PMI. This is the insurance you're required to have when you put less than 20% down payment on a new home. This will benefit lower net worth families buying a home because it also impacts FHA and VA loan borrowers. Now there's also a new category that was added for those that are itemizing their deductions. This is a significant change for teachers, coaches, and other educators who spend personal funds on educational materials for students. In the past, you would get up to $300 if you were single or $600 if you were two married teachers. This was allowed if you didn't itemize. But now this new category of educator expenses will start in 2026, but it would only benefit teachers that do itemize their deductions. So it does add some more complexity and will benefit some over other teachers. Family changes, there's been quite a few changes. Just like with seniors getting several new deductions, there's been quite a few new family tax changes. For one, the child tax credit. This is permanently increased now to $2,200 per child, which is an increase from $1,000. The credit is now phased out for income over $200,000 if you're single or $400,000 if you're joint. So again, benefiting the lower to middle income families and not benefiting the higher income families. The Dependent Care Flexible Savings Account, which is a way to pay for childcare pre-tax, is now increased to $7,500. This was previously $5,000. There's new incentives for employers to offer child care for their workers. And finally, up to $5,000 of the adoption credit is refundable, meaning even if you don't owe taxes, you still receive the $5,000. And this is now also adjusted for inflation. As I mentioned before, surprisingly, many of these new tax provisions cap the deductions and the benefits for higher income families. So now there's a new cap on higher income families. During the negotiations, there was rumors that the Republicans were going to increase the highest tax bracket back to 39+%. This didn't make it into the law, but the new law introduced a cap on itemized deductions for high income people in the top tax bracket. And what this does is reduces itemized deductions by a complicated formula, 2/37ths, which essentially provides less benefit to the highest income earners who normally itemize their deductions. Finally, for the gamblers out there, I'm sorry we have a loss for you. Under the prior law, if a gambler had more losses than gains in a year, they could deduct the losses up to the amount of gains and thus have $0 of net income for their gains. Under the beautiful bill, only 90% of losses will be deductible starting in 2026. This makes it more likely for gamblers to have taxable gains even if they lost money. I'll be back later this week with more about the One Big Beautiful Bill and the impact on tax laws. But until then, have a wonderful week and I'll see you soon. Bye.